My name is Bubba Page. I'm a serial entrepreneur. I'm an angel investor, and I founded Influence.VC. So talk to me specifically. Let's get to the brass tacks of the biz.
Yeah, first off, thanks for your interest, Bubba. Seriously, I came from a big company, Circus Tricks, to our first venture entrepreneurship journey with both my partner and I. And when somebody sits across from you and wants to give you some of their hard-earned money or their friends or acquaintances' hard-earned money, that is a huge deal. I don't know, I feel a huge responsibility to be a steward over it and help it grow. And ultimately, it's such a huge compliment to be considered, whether it's you or other investors. And so what it's looked like so far and how we've grown this is very similar to the founding of Circus Tricks. The founder, Case Lawrence, one of the greatest guys, Utah guy. I think he was Ernst & Young Entrepreneur of the Year. He wouldn't say that, but he was, and he's a great guy. And we tried to model our initial growth strategy similar to how he started out with Circus Tricks. That was finding capital partners and structuring it to a 50-50 deal where the capital coming on is 50% ownership on the cap table, and the operating arm, which is Ty and I, would take 50%. And so that's what we had pitched, and that's what we've come to the agreement on these initial locations. And obviously we got to find locations, whether we're building new or whether we're acquiring an existing trampoline park and just remodeling it and putting our brand on it. The target cash on cash return we want for our investors is 20 to 25%. I will say that in all the Ninja Kids action parks that are open, we distribute monthly and the returns are over 30% cash on cash.
Oh my gosh, that's fantastic.
And that's at that cap table split. A lot of the decisions with respect to the operations and the brand stick with Ty and I. But with respect to things like bringing on debt or voting rights, we try to have say from our investors and just make it a win-win. And so that's our deals are structured. We do have one group, Bubba, that we've signed. They have a right of first refusal on deals. They are not a syndication. It's just a family, not really a family office, just a family that is excited to grow with us. Now, obviously, we know that their funds are greatly appreciated and we're going to grow with them, but we know that they're limited. And so we want to have these conversations because we have 7 now, and we see a road really quickly where we can get to 20, 25 parks in the next couple of years. So we need capital to do that and beyond what we currently have. So that's the very high level. I'd love to answer any questions or kind of provide context on any of the details there.
Yeah, well, and what's interesting is a lot of the venture capital deals that are coming my way, usually they're investment for equity only, and then it's a 5 to 7, even maybe a 10-year window before investors see a return. So a lot of venture capitalists or just angel investors are looking for cash flow type opportunities right now. And that's what I'm hearing a lot from my own syndication of investors, is that they're looking for these cash flow opportunities. And so it's the right timing. Can you share with us a little bit more with the 7 that you have? 3 of them are currently up and running and functioning, right?
Yes.
And then the other 4 are
in process,
in process, or construction or in the acquisition process. Okay. So those ones you'll have more data on later, but for the 3 that you currently have, how long have they been running? And if you're able to share, what do the revenues look like and what do the profits look like? This is almost like a Shark Tank-esque moment of sharing some of that. Again, whatever you're comfortable with.
Absolutely. Being in this industry for a while, you kind of get an eye. I'm similar to folks in other industries. You see an asset and you understand, okay, what are the unit economics based on the competition around, the square footage, et cetera. And so the 3 parks that are currently open were all parks that were already open running as trampoline parks prior to us coming in with the Ninja Kids brand. And the strategy behind, I think, doing both is a lot quicker to get a business open like Ninja Kids Action Park. If we wanted our first park to be a brand new build from the ground up, we would still be waiting on location 1. So to have an opportunity where we're pursuing both the acquired parks and new parks we like. With the acquired parks, we had full diligence before we buy the park. We know what the ratio is, what the EBITDA looks like. And it's been a cool experiment to see. Truthfully, the biggest lever is this brand on top of the park. But you can't just put a sticker on something and It's going to be great. We put so much effort into what the park looks like, what the park smells like, what does it sound like. Every single Ninja Kids park, we spend tens of thousands of dollars on the paint and what does it look like, the ceilings, and making sure we just nail it because the brand deserves it. And ultimately, we want to make sure that as we move forward, it's not like a stereotypical smelly trampoline park.
Smells like dirty socks and stinky kids. Yeah, I hate to say that. We've been to a lot of them. You don't want to go to the foam pit because you're afraid of what kind of diseases you're going to get out of the foam pit, right? I noticed, obviously, you guys have done a really good job with that one, the South Jordan one.
I appreciate that. And yeah, it's not an accident. We're very prescriptive and we have incentives with our operators around the look of the park, the safety of the park, the cleanliness of the park. We have these levers that we know just from our past experience at Circus Tricks, plus this brand lever. And ultimately what we've seen is all three parks revenues have over doubled since we've taken over.
Wow. So they were previously a trampoline park doing the exact same thing. You guys put your love and care into the facility, bring in the new brand, and you're doubling revenue.
Some of the locations are coming up almost like a triple on our EBITDA. The more revenue a trampoline park brings in, the higher the profit margin is, the lower the percentage of payroll. And so we're seeing in Dallas, very healthily above that, the doubling of the EBITDA. I'd be happy to share more exact numbers with you.
Yeah, absolutely. No, I think that's fantastic. Okay. Now, looking at partners, so you have a current first right of refusal type of investor who can look at any deal that you guys are doing and they can take the whole thing or they can take part of it. And then usually how much are you raising on a per location basis? And is there any opportunity to invest in the entity itself versus just on a per location basis?
Yes, there's a first right of refusal to invest in the whole deal, meaning 50% of a location would be their portion. Or if they would want to do some sort of syndication, or not syndication, but they want to make their money go farther, they have talked about, hey, can we invest not the full amount and then we just go raise at the same rate and try to fill that location. As it sits right now, what we've done is every single location is its own entity, its own LLC, has its own cap table and own separate investors. We truly haven't put a lot of thought into what like investing in the whole umbrella company would look like. What we're focused on, and kind of similar, just mirroring what we've seen in the past with Case, is doing these park by park. But I would love to have a conversation of what that potentially could look like. But as it sits now, all seven have 7 different LLCs. And you're right, the family does have a first right to either take the full deal or take a partial of the deal.
Okay.
To be honest, I don't think there's unlimited funds there.
They would be open to other investors to come in, possibly, is what you're saying.
They are very open to other investors.
Okay. Yeah, I think that's fantastic. So I'm looking at this primarily, you've got a per location basis, a cash flow opportunity, right? Now, if that location were to be sold, is there an equity component that the investors would be participating in?
Yes. If that individual location sold, or we wrapped up and sold the whole company, then we would distribute. We want to make sure that the invested capital is returned to the investors, and then whatever ownership they have on that cap table is what would be the exit. We sold the business.
Yeah. And that's when I bring up the umbrella idea, is that let's say you have 100 locations in 5 years, or whatever, 300 locations in 5 years. Yeah. If you wrap that all up into one umbrella, would the investors be participating in that umbrella or just on that per location? And right now, my understanding is it's a per location.
Oh, yes.
If an investor would come in as a per location.
As it sits right now, it is per location. You mentioned kind of venture capital versus these cash flow businesses. So what we've done with all these businesses, typically trampoline parks are seasonal a little bit, but mostly every month they're cash flow positive. And so once we buy the existing business or we're building and we open, we keep 4 weeks of working capital and then we distribute monthly to our capital partners.
That's amazing.
And that starts after we've grand opened and we get that working capital base, everything else. We're really proud to distribute monthly to our capital.
So that anybody listening can be super clear. So let's say I give you money today to open your 8th location, and I'm coming in with my group as an investor, and we put in $1 million. I'm just making these numbers up, but let's say we put $1 million in. If we did it today, by the time you got your 8th location up and running, is that a year's time frame? Is that 2 years time frame? And then when do you see the initial check of return of capital? And then what would that potential monthly cash flow be, since if, between 20 and potentially 30%. So are we looking at 2 to 3% a month in cash flow of that $1 million?
Yeah, these are great questions. If $1 million came to us, I think it would depend on if it was a trampoline park that we were building. We sign a new lease and build from start. Typically, to go from getting cash to then building a brand new park is 12 to 16 months. That's when you would start to see the park grand open and then a return on the capital. If it was a park where we've acquired an existing park and have done a rebrand, like in Salt Lake, those typically take about 6 months from when cash is deployed to where the renovation is all done, grand opened, and then that's when the distributions would start. So they would be monthly and be cash on cash. So if we have $1 million coming in, our target that we want to make sure we deliver to our investors is $200,000 annually, which is broken up. Yeah, there's a little bit of seasonality, but you should expect about 1.5–2% per month to come back. And like I said, I'm not one to promise what we could do, but
it may be higher. There's a potential for it to be.
Yeah, it's been really well, and every month you're seeing a 3% return on that money. Some of these parks, which is awesome for our investors, awesome for us. The Ninja Kids are excited to get their brand in the physical world. It's really a win. So that's what we would expect for location 8, depending on if it, again, was a new build or an acquired park.
Yeah, it sounds like from an investor standpoint, an acquired park is way more attractive because I'm getting that cash return in half or less speed, or twice the speed of another one. So from an investor standpoint, I'd be like, yes, go find one and buy one, versus building one from scratch so that we could get the cash returns faster, right? I know our time is up. So just wrapping the last, put a bow on it, finding out, and maybe you can ping me afterwards with how much are you raising and for what locations of parks? What's the time frame that you're looking at so that I can gather that information. And then if you have a due diligence packet that you put together for other investors or for other partners, anything like that would be really helpful so that when I reach out to my group, I can have all my ducks in a row to make sure that I've done my due diligence, that I've looked at what's happening and be able to talk to the correct people in the right place.